Peter Lynch was one of the finest investors that ever lived on this earth. He once remarked that a lot of money is lost when investors are waiting for the perfect time to get in the market, and hence time in the market beats waiting to time the market. Hello and welcome to this podcast today. On this episode, I'm going to share with you some major market updates in the stock market, particularly in the US and Canada. I'm also going to review what I think are the key things to focus on in the market. Now, for those who don't know me, my name is Isaac Jonas. I like to talk about personal finance and investing. But before we get started, I just want a disclaimer that this content is meant for educational purposes and it should not be taken as investment advice. Investing is personal and sometimes circumstances differ. So it is very important that you consult financial advisor before you even invest money. But also, if you want to learn more about investing and personal finance, feel free to book for time so that we can talk one-on-one or in a group setup via streetwiseeconomics.com. Now, like I said, I'm Isaac Jonas and I'm a principal consultant at Streetwise Economics. And academically, I earned 2 master's degrees from the University of British Columbia, that is Master of Food and Resource Economics, and a Master of Arts, Resource Environment and Sustainability, in addition to a Bachelor of Science degree in Economics from the University of Zimbabwe. I have also authored a book called The Intelligent Millennial Investor. Ideally, my goal is to just share my experiences investing in the stock markets. I have been investing in the stock market since 2020 when the COVID pandemic hit. That's when I started, actively participating in the stock markets, particularly in Canada and the US. But I have learned that there are quite a lot of things that I did not learn in school. So I'm going to share some of those insights here and just so that probably you may find them helpful. Now, what I usually do is there are different approaches to investing. Number one, some investors, they look at the technical analysis to say, these charts, are they indicating that it's going to be bullish? In other words, is the market going to go up? Or bearish? In other words, is it going to possibly go down based on the sentiment? But all these are just, based on probabilities. But I also like to look at the what I call, fundamental analysis. Basically, I like to also look at the news, major economic data points, and combine the two, the technical analysis to look at the charts, in particular for the securities that I will be investing in. So now when I look at these two aspects, the technical and the fundamental analysis, I then combine it with some economic theory or macroeconomics. In other words, how I understand the economy, because the way investors work is that there are some things, if they happen in the economy, for example, people don't have enough income, disposable income to spend, most likely they are not going to invest in the market. So now, as you can see on the screen, there are some major economic updates, some data that was released last week. And these data usually, in addition to other factors, of course, they usually drive the markets. Markets can either go up and down. I see a lot of people, they try to give the impression that they can predict the market. Of course, I'm not saying it's not possible, but it's highly unlikely, because let's picture it this way. People can possibly wake up and just freak out because maybe there's an economic data point. This happened 2 weeks ago when the market dropped. There was what was known as the yen carry trades. Most investors, actually, it's estimated that it's about $1 trillion that was actually leveraged. They were borrowing in yen, Japanese yen. They were borrowing the Japanese yen, converting it to the US dollars or other currencies, and then buying securities in that regard. Now, the Japanese economy, in terms of the interest rates, it was very, very low, and people were then converting this and investing in like treasury bills and other stocks, for example, in the US, that were going up and taking the profit. Now, because the Japanese economy, um, 2 weeks ago, it dropped, the Nikkei, their market, just like the S&P, the Nasdaq, or the New York Stock Exchange, it dropped, right? Their major index. And a lot of people, they panicked because the Bank of Japan now indicated that they were possibly going to increase interest rates. That perception alone, investors think that because of that, those people who had those loans, they thought probably, well, if these interest rates in Japanese yen were going to be increased, they were going to be hit hard. So they started selling off. So what that means is that there was a selling off in the US market. And I was in Washington, D.C., and I was watching this, seeing this drop, and compounded by the job numbers that kind of indicated that the Federal Reserve Bank in the US was probably um, not going to obviously decrease the interest rate. So you see, it's full circle. The economics, and sometimes things that are really unexpected can happen. So when I look at the data from this week, what happened is that the key thing was that for me, all these data points, the core CPI, which was year on year, it shows that inflation, it dropped to 2.9% for July, right? Basically, inflation is the increase in price at a given period of time. So if you look at the year compared to last year, July, prices have dropped by 2.9%. But analysts were forecasting that probably the number was going to be 3%. So this really buoyed, caused investors to actually be bullish in the sense that the market went up because they were anticipating that in September, when the Federal Market Open Commit that is chaired by Jerome Powell in the US, when they hold their meeting to determine the monetary policy, in other words, the interest rates or the money supply, they are more likely, there's a probability, that increased probability, I should say, of reducing the interest rates, which means the cost of borrowing for companies. There are a lot of companies that have, like loans that borrow money. So what that means is the cost of borrowing in that case might be lower. So companies can possibly expand, hire more people. So this news actually caused the market to increase. So this is very key. And also the retail sales, companies like Walmart, it showed that the sales increased by 1%. So these, I think, were things that possibly caused the market to go up. And also the initial job claims, in the US and in Canada, when people lose their jobs, they file for employment, basically employment benefits. They get, when they are working, they will be paying some insurance premiums that is put in a pool, that is then invested, so that if people lose their jobs and certain conditions are met, for example, they work for a minimum number of time, then they can get some income. Usually in Canada, it's kept to a certain number, for example, 650 Canadian dollars per week. So now I just wanted to give you an overview. But what I've observed is that, this is something that is common. Every week there's something that is going to happen. And some of the things are really unpredictable. Nobody could possibly say that, maybe there is going to be instability in this other part of the world. For example, there's geopolitical tensions in the Middle East, in the US, there's also an election. So as an investor, when I look at these major updates, you can see on the screen, right, that the market largely was up. If you look at the S&P 500, which is the US 500, it was up for this week. When I was making this presentation slides, it was 0.21% for the past 5 weeks, five days. Now, you will see that in Germany, the German DAX, that is their index, it was 0. It closed the week at 0.8%. And the dollar index, it dropped. In other words, a lot of people, they are now going back in the equities market, right? They are going to buy shares. When I look at, the gold, some people actually, they are also investing in gold. You can see that the gold price this week, it actually averaged, 2%. Now, in terms of the individual companies in the US, Apple, Tesla, and Alibaba, which is a Chinese-based company, even though people can, buy through Alibaba from all over the world, but it is it is a Chinese business, even though it's listed in the US. It really went up after their earnings. Now, what this means for me as an investor, a retail investor, is that I want to keep invested in companies that I really understand and I get in when they are undervalued. I've said this again and again. So patience is really, really key. So what it means is that right now, I'm not really buying, these companies, because now they are going to back to almost close to all-time highs. When I see that, I like to think of, when the market goes up, usually, especially if it goes all-time high, it means there's no supply zone, but there's the demand zone. It's more likely to go back down, get support, and go up. So this is something that I've also learned over time. So I kind of think of how to hedge my portfolio. In other words, I can buy some exchange traded funds. Like right now, the VIX, it actually went up when the equities market, it dropped, but now it has gone down again. So that is something that I've been buying, and this is not investment advice, by the way. Also, I like to have a bit of cash, and also sometimes people invest in bonds and treasury bills. The key from what I've seen as a retail investor since 2020, sometimes I just, wake up, I start reading what's happening in the market, I start analyzing companies, but I tend to observe a pattern that investing is very easy if you understand what you are doing, but it's extremely difficult to beat the S&P 500 index, right? Why? Because again and again, people panic. It's human behavior, even if there's a negative headline or something, right? So it's very important, from what I've observed, to have a portfolio that, is hedged. In other words, if the market drops, if it goes up, so what some people do is they have different baskets. For example, they have some cash, maybe 20%, they have equities, maybe 40 or 50%. That can be exchange traded funds, invested in exchange traded funds, or individual companies that they really understand. And probably treasury bills, if they're giving 4.5%, if you buy treasury bills, let's say government bonds for the federal government of Canada, or the provincial governments, you can see those, maybe they are giving 4 or 5%, which is above inflation, right? And then sometimes people I can just think of other securities such as gold or silver, but those are commodities or crude. It's very, very important, from what I've seen, to stay within your circle of competence, because in the market, a lot of things can happen, right? Even if, for example, next week, I think there's the Jackson Hole event where eminent economists and central bank governors will be meeting in Arkansas. Basically, these are people who are policymakers, and they will be discussing, and it's a conference, they will be talking. Sometimes, if, let's say, Chair Jerome Powell says something, people may interpret as if maybe they may not decrease the interest rates as what the market is pricing in. It might cause a potential drop. That's when I cash out, if I have a hedged portfolio. Those big swan events that are unexpected sometimes can actually be a huge opportunity to become rich, because if you have maybe even 10 or 20%, it's something that can happen, but it's kind of like speculative, right? So it's very, very important, from what I've seen, to make sure that you avoid using leverage, because if you are borrowing, it means also the market is the market can go in either way. So if you are leveraged, odds are against you, because let's say if the market drops and the securities that you own also drop and you are leveraging other accounts, it means either you have to sell when you get the margin call. In other words, the broker will say, hey, you have to either liquidate some of the positions that you have, and sometimes it's at the bottom. So what people do is they end up, liquidating that so that there's liquidity, because it's like if you go to the bank, you get a loan. What they do is they want collateral security. So that could be in form of the shares or stocks or securities, whatever securities that we have in that broker. So I stay away from using leverage. Not to say some people do it and they actually, make money out of it. So that's something that I've learned, that also timing the market is very, very important, because over time, sometimes if you miss the most, um, the best days in the market, it's hard to really recover, because if the market really goes up by 4 or 5% and you are not invested, then, you might not, get that chance again. So I thought I would just provide this brief update, and I hope you enjoyed this. If you have any comments or if you would like to connect, please feel free to book for a one-on-one session via my website. You can see www.streetwiseeconomics.com, and you can drop me an email. And I also have, this YouTube channel that I, regularly provide these market updates. But may the markets be with you. I wish you nothing but the best. But please, make sure you understand the things that you invest in. Investing comes with a lot of risk, and sometimes people even use options, which comes with quite a bit of leverage. So thank you so much, and have a wonderful week ahead.